In the consolidated statement of financial position of the P Limited Group, the only amounts that's different when comparing example 5.2 to 5.1 will be my retained earnings and my non-controlling interest because of the different measurement of NCI in example 5.2 because my subsidiary is the selling entity. As you would note, next to the inventories line item, the calculation is exactly the same regardless of who the selling entity is. I start with 100% P plus 100% S. The unrealized profit in opening inventories does not have an effect on my closing inventories at the end of 20x11. And the unrealized profit in closing inventories is excluded from the year-end balance. In the consolidated statement of profit or loss and other comprehensive income for the year ended 31 December 20x11, you would note that the total profit for the year of the P Limited Group in example 5.2 is exactly the same as how it was calculated in 5.1. The reason for that is regardless of who the selling entity is, the effect on the line items in this blocky would be exactly the same. You would still eliminate the total revenue and the total purchases. The unrealized profit in opening inventories would still have to be excluded from cost of sales to increase gross profit, and the unrealized profit in closing inventories would still have to be added to cost of sales to decrease gross profit. The only amount that you would see as different when comparing 5.2 to 5.1 is the measurement of your non-controlling interest in profit for the year. We have already looked at the calculation of that amount when we discussed Journal 7. In the analysis of equity, we will focus on the effect of the intragroup sale of inventories where the subsidiary was the selling entity. The at acquisition section of the analysis of equity is the same in example 5.2 and 5.1. In the since acquisition to opening balance period, the only equity item identified in this example was retained earnings. The work method is to start with the trial balance retained earnings opening balance of S. Then we adjust that balance with the effect of related consolidation journal entries. The first one is the elimination of the at acquisition retained earnings. Because the subsidiary was the selling entity, the unrealized profit in opening inventories was adjusted against the retained earnings opening balance of the subsidiary. So I have to include the effect of that journal on the analysis. That then gives me the retained earnings of the subsidiary that's allowed to be in the group. That amount can then be attributed. If I follow the same approach for profit for the year as the only equity movement in the current year, I start with the TB profit of the subsidiary. Then I adjust that profit for the year for the effect of those consolidation journal entries that change the profit of the group and specifically the profit of the subsidiary that flows into the profit of the group. Because the subsidiary was the selling entity, the unrealized profit in opening inventories and the unrealized profit in closing inventories is adjusted for against the profit of S. That then gives me the profit of the subsidiary that's allowed to be in the group, and that is then attributed to the parent and NCI. Please compare this analysis to the analysis in example 5.1 to see the effect of when you adjust for the unrealized profit in opening and closing inventories. In the consolidated statement of changes in equity for the year ended 31 December 20X11, the share capital is only that of the parent. The non-controlling interest amounts you can get from the analysis of equity that we already looked at. So I will now focus on the retained earnings opening balance calculation and the profit for the year calculation. In calculation H, I calculate opening retained earnings. I start with the opening retained earnings of the parent, and I add to that the opening retained earnings of the subsidiary that is attributable to the owners of the parent as I've calculated it in my analysis. Please note the 400 Rand adjustment because of unrealized profit in opening inventories has been adjusted for in the analysis of equity against the retained earnings opening balance of the subsidiary as the selling entity. In calculation I, calculating profit of the group, I start with the profit of the parent. I add to that the profit of the subsidiary that is attributable to the owners of the parent, which I've calculated on the analysis. Please note the 400 Rand and 600 Rand relating to the unrealized profit in opening and closing inventories have been adjusted for in the analysis against the profit of the subsidiary, as the subsidiary is the selling entity. I am not adjusting for it against the profit of the parent as I have in example 5.1.